Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Scott Melker, crypto trader and investor. He's also the host of the Wolf of All Street podcast and the author of the Wolf Den newsletter. He joins me to discuss the four-year Bitcoin cycle and what it means for Ethereum and alts. Scott, it's great to see you as always. Welcome back to Trade Talks.
Thank you so much for having me.
You got it. And you said on Twitter this morning you could have literally fallen on your head and been in a coma and missed all the macro news and global market issues and simply followed the four-year Bitcoin cycle and how it then trickles down to Ethereum and the alts, and you could have been fine. Explain the cycle and what it means longer term for Bitcoin. And is it like that sell in May and go away, or is there more to this cycle than an adage?
I think there's more to this cycle than an adage, although it's just as simple, really, when you dig into it. Bitcoin has what's called the halving every roughly 4 years, and that's when the new supply coming onto the market is effectively cut in half. So if you even have a basic understanding of supply and demand, if demand stays the same or even decreases slightly or goes up with reduced supply, obviously you're going to see price rise. And we've seen that with every single cycle, and we've seen price bottoming, a couple years into that cycle before chopping sideways and moving up. And that bottom that we saw from FTX in November and sort of the move up has followed that exact cycle that we've seen in every previous market. And once Bitcoin starts to move up, you gain renewed confidence in the market, you get a bit more liquidity, and then that starts pouring down into other coins like Ethereum and then farther down the risk curve. So basically every time you see Bitcoin move up and consolidate, it goes into altcoins, back into Bitcoin, all the way up. It's effectively a washing machine. But, if it ain't broke, don't try to fix it. And there's no reason right now to assume that this time will be different.
Scott, it's so interesting. You've been coming on the past 3-4 years, the same Thursday of every month, and every time you come on, there's some kind of news that we have to talk about. Twitter is going to give users the option to buy and sell stocks and other assets from Etoro. What does that mean for Twitter and Etoro? And how do you think the community is going to interpret this?
Well, I think it's big for both, but honestly, I think it's bigger for Etoro than Twitter, obviously. This is effectively giving them a huge marketing funnel and audience. And at the end of the day, even if you can check the charts and look at the data and trade, quote unquote, through Twitter, my assumption is that you'll still have to sign up for Etoro, do KYC on Etoro to make sure it's compliant. Otherwise, there's no way that the SEC would allow something like this to happen. So to me, this is effectively a marketing funnel and just a way for Etoro to open up their floodgates to new traders. I think that it's a net positive, certainly for both platforms and for the markets in general. I mean, Etoro was founded by Yoni Asia, a Bitcoiner. He was the first person to really create almost altcoins called colored coins on Bitcoin. So the crypto community has a deep sort of relationship with Etoro, and I think obviously with Twitter. And so it's a perfect marriage for that community on Twitter.
FTX managed to recover $7.3 billion in assets and is considering restarting the exchange. And I read about that and I'm like, what and what? How did that kind of all happen?
Exactly the right reaction. I think it was originally a $13 or $14 billion hole. So we're still only talking about roughly a 50% recovery. But interestingly, if you looked at the claims market and people who were trading these bankruptcy claims, there was a time right after FTX when people were selling their claims for 5 cents on the dollar. And it's looking now like they've recovered 50% of the assets. So obviously anybody who's been trading these claims has probably made quite a lot of money buying them. That said, turning the exchange back on, to me, I just don't understand how that's going to work. I think under new leadership and management, the technology was potentially good, but I think it's such a stain on the industry and such a negative name that I very seriously doubt that people are going to rush in to trade on FTX again. I think the better path here for recovery is just to get as many assets back as they can and distribute them without wasting as much money on lawyers and advisors as humanly possible, which we've seen with some of the other unfortunate bankruptcy proceedings in the industry.
And Scott, I want to wrap up and talk about USDC. You've been doing a lot of work on that. In fact, you just hosted a pretty incredible Twitter Spaces on it. What was that around? It seems as if other areas of the world are making some headway when it comes to stable coins, and we're playing a little bit of catch up here. Is that concerning?
I don't know that it's concerning. I think that competition is certainly good in the market, and we want to see more than one stable coin and people using them for different purposes all around the world. USDC obviously had a bit of a wobble with the Silicon Valley Bank. They had $3 billion with that bank. So there was some concern before we saw the FDIC basically step in and say they would backstop all of the banks. There was some concern that they were going to lose their peg. But USDT, which is a much bigger market cap and traded all over the world, they made $700 million in the last quarter. people forget that if you're a stable coin and you're backed 1-for-1, you're likely investing in short-term treasuries. So that's how they're making just an absolute boatload of money, just literally taking your money, putting it in treasuries, and then they're there when you need to redeem. And incredibly, if you look, I mean, there was a time last year, I think it was right after the Luna collapse, that USDT had $7 billion in redemptions in 48 hours and was able to do that without a hiccup. There's no bank, even in America, clearly, that can handle that sort of redemptions. We've seen it of late in that short a period of time.
All right, Scott, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.